Money Radio for a really great future. We're talking real money.
Well, it's been a heck of a week. It's really been a heck of a money week. There's been a lot of money stuff going on. And we're not just talking about the stock markets, because the stock markets certainly have been volatile over the past month with the new presidential administration and tariffs and all of that. But other things are of concern to people right now, like what's stuff going to cost in the future?
Yeah, and it's going to cost more.
There's no way around it, and that's what we want to talk about. What is likely to be the impact of the new crazy town tariffs that are being imposed by the current administration, that are being put into place like now?
They're not proposed. These are
the 10%ers went in effect now. They're there.
Yep.
What is this going to do to your bottom line, to your life?
But let's talk about what a tariff is first. What in the world is a tariff?
Honestly, I don't think a lot of people really understand tariffs.
No.
Tariffs were the way that the government was in the United States was originally funded. There was little else in the way of taxation in the early colonial government of the United States.
Well, we've only had an income tax for 100 years.
Yeah. A tariff is a fee charged to the person or company purchasing a product from a supplier in another country, in the case of countries. So if you have a shoe, and the shoe is made in Europe, and this was a long time ago, and the shoe was shipped to the United States, the United States shoe distributor,
can you say shoe shipper,
would pay a tariff to the United States government for bringing that into the country. Now,
that's the important part, that they've got to they have to collect that and give it to the government when it comes here.
Right, and they did it back in the old days through what were called customs houses. It was a very lucrative job, by the way. It was one of those jobs that was given to people who funded presidential campaigns.
Shockingly,
and they did quite well because they skimmed a little off the top.
I think I should set one up here on the lake. I think maybe.
I don't think any goods are coming across Lake Margaret.
Okay.
I mean, if there aren't any coming across Lake Washington, they're not coming across Lake Margaret.
Good point.
But let me give you our phone number real quick, because we do want to talk to you about things that impact you day to day, whether those be tariffs or other things. Probably not tariffs, but we like to talk about them once in a while. We want to answer these questions. 855-935-TALK is the phone number. That's 855-935-8255. Now, we're going to get to the phones in a minute, but I want to give you a specific product and what the tariffs might do to that product.
You're going to talk? You're not talking the shoe here. Now we're going to talk about something a little more regular use in your hands.
I was actually going to talk about Chinese or Vietnamese shoes.
Okay.
But Joanna Stern of the Wall Street Journal put out a great piece on the cost of an iPhone.
Yeah.
Which I've got one sitting right here. You probably have one sitting there. Yeah. Okay. This is the iPhone Pro 16. With a 256 gigabyte memory. The iPhone Pro, all of the bits and pieces and parts in it, along with the cost of putting it together, come to $550. That's the processor, the display, the battery, the modem, the memory, the storage, the cameras.
When you got to test it, they said it's $580 with testing.
With the testing. Then you throw the testing and all in. Yes. Throw in the assembly and the testing. It's $580. Then Apple today sells that for what is a very typical markup in retail. They sell it for almost double that. They almost double it to $1,100. That is pretty typical. That covers... That's not just Apple. That's not pure profit. That $520 is not pure profit to Apple, because they got to pay for their building, they got to pay for their employees, they got to pay for their marketing, they got to pay for their stores, they got to pay for the salespeople, they got to pay for the people who all along the way with their hands out. So right now, current system, $580 phone, gets you an $1,100 bill
price
when
tag.
you go to
Yeah.
buy one.
Correct.
That's the price.
Yep.
So what will happen if we add in the new tariff?
Which it comes from China, right? This 34% right off the top, correct?
Well, actually, it's worse because we've got pieces that are coming out of China, South Korea, we've got Japan, we've got all these other things. So the tariff on this altogether, based on the current plan, and remember, China's getting hit with a worse tariff, but it's all going to add up to 54%.
On top of the 11, well, whatever.
Yeah, $297 on top of the $580.
So
now
you can do the math.
Is
now
Apple
the
still going to charge $1,100 when they're paying $300 more to bring the phone into the United States? They can't do that. At the very least, if they don't improve their profitability at all, they just they just pass along that cost. The next iPhone of the same quality, the same caliber, has to be $1,400. Has to be.
So that's about
at
a 30%
the least
increase.
That's at the minimum.
And remember what we're trying to accomplish here, according to the administration. What we're trying to accomplish here is more things made in the United States. The article points out that the labor bill for that, $30 in China, $300 in the United States to make the same product. So think that through.
Either way, if we make it here, it's $300 more. If we make it there with the tariff, $300 more.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Apple aficionados are notorious for upgrading their phones every year, every 2 years.
Well, you do that every 15 days.
I do it like every other month. But here's the thing. What is going to happen when the next iPhone costs $300 or $400 or $500 more than the previous one?
It won't be good. My guess is they'll sell less.
Fewer people will upgrade. They'll keep their old phone because they're made to last a long time. They'll keep their old phone, and Apple's sales will plummet. Well, what will happen not just to the stock of Apple, but to the stock of Apple and Qualcomm and Sony and Taiwan Semiconductors and all of those companies that provide stuff to them?
Or the people that aren't they tied, like Verizon that uses their there's a
Verizon, T-Mobile,
there, right?
AT&T, all of them. What it's going to do is it's going to hurt the economy. There's no way tariffs can't. The tariffs are an anachronism that should have died a long time ago. They might occasionally work in a protective capacity, but businesses evolve and you can't stay in the past, and they are. I don't care who you're talking to. I guarantee you there's not an economist worth his or her salt who is going to tell you that tariffs are not inflationary. They are inflationary. They have to be.
Yeah. It's hard to find a lot of economists who support them. We can say there are a few, by the way, because I read a few this week, but not very many.
The very conservative editorial folks at the Wall Street Journal hate these tariffs.
I know. Yeah.
So funny. It's not often that the New York Times and the Wall Street Journal editorial pages agree on something.
They met somewhere in the middle of the island.
No, they met clear over an agreement. 855-935-TALK is our phone number, and Andrew's been waiting, so let's get to him. Hey, Andrew, welcome to the show.
Hey, good afternoon. Thank you for having me and taking my call. I wish I was calling about a tariff issue or a stock market issue, but I'm calling about a fixed income annuity.
Oh, I love these things. Let's do it.
I know.
I don't love them. That's
a great diversion from tariffs and stock market downfalls. We love hearing this stuff. Sure.
Well, I may have made a bad decision, but long story short, I had two brokerage accounts in two different states. Neither of them were in the state that I reside in. I'm a couple of years away from retirement. I moved both accounts into one firm that it does retirement planning. So I met with them and we discussed a lot of different options, and they of course put me through their risk assessment test or questionnaire, and what do you need to live on monthly in retirement. And I have, a couple $1 million in a 401k. I have some cash. I have some real estate. The value of the accounts that I moved into them was about $1 million. And when I retire, I'll have a nice pension. I'll hopefully have Social Security. I'll have a couple of other things, but I was short of what I would need monthly in retirement.
Okay.
What I would like to have had.
Mm-hmm.
So they started talking to me about a fixed income annuity.
Mm-hmm.
And I ended up buying a $525,000 annuity, payable $60,000 a year when I turn 65, payable, of course, to the death of either myself or my wife, whoever lives the longest. And you guys were talking about this a few weeks ago on the show, the commission for the sale. I asked the firm what their commission was on that sale at the time I was buying the annuity, signing the paperwork. And they said, "Oh, we don't know." And I said, "Well, what do you mean you don't know? How do you not know what you're going to get paid to sell me a $525,000 annuity?" And they said, "Well, we don't know they don't tell us what they pay us till after we do the annuity, and it's different on every annuity and the type of annuity." I said, "Okay." So in my mind, I was thinking, $5,000, $6,000, $10,000 maybe. And so I wrote to the firm the insurance company that wrote the annuity. It was North American. Mm-hmm. And I said to the president, actually, of the firm, and I said, how do you sell an annuity and you can't tell your customer what the broker's being paid to sell it? I said, that doesn't seem right. And so they actually responded to me, and I responded back, and they finally told me what they paid the broker, and it was $45,000. Mm-hmm. And I thought, boy, did I just buy something that did I make a bad decision, right?
No. Okay.
Should I have taken that 520? Yeah.
Okay. You want to do this? Or you want me to do this?
No, I can tell you. The gleam in your eyes is just. Okay. You go ahead.
What? No. See, this is not okay. If this was an indexed annuity, I would be up in arms. I would be fit to be tied. I would be bouncing off my padded walls. But because this is an immediate income annuity, it's not as horrible.
He didn't say immediate. He said fixed income annuity.
So, but when you retire, it's going to.
I'm 57.
Yeah, but it's going to become an immediate.
I will receive my first payment at 65.
Yeah.
So
it's a fixed income annuity now, and then it's going to turn into an immediate later. Okay? Here. Let's just go way back. Did they tell you what the surrender charge was?
No. Okay. I shouldn't say that. They may have, and I may not know. I may not know that number.
I'll tell you what it is based on what you told me. I'm going to tell you what it is.
Yep.
It's 10% the first year. So if you wanted to take your money out, you would have to give them $50,000.
Yeah.
Why would you have to give them $50,000? Because they paid out a $45,000 commission.
But I don't remember Andrew saying that was his question. So what?
No, it wasn't. It wasn't. It was, did he do a bad thing? You didn't do a terrible thing. You did something that a lot of people. What you did is you bought yourself another pension. That's basically it. You bought yourself another pension.
Which I would argue you didn't need.
Yeah, I would argue you didn't need it. But there's only two ways to go from here. And I wanted to go back to the $45,000 commission for a moment. I really would like to talk about that. So hang on with me for just a minute, because I'm trying to, no offense, but I want to help you, but I want to use you as an example to other listeners about how evil this industry is, inherently evil.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
All right, I am diverging from the question a little bit that Andrew has. Our number is 855-935-TALK, by the way, if you want to call, because I want to make a point. I really do. Now, again, Andrew, is what you did bad? Not necessarily. What you might want to do is reconsider down the road, and you get past that surrender charge, and you could do that. You could then take the money out and put it in something else because it hasn't become an immediate annuity yet. It's a fixed income annuity. Once it becomes an immediate annuity, though, you can never take the money out again.
Once it annuitizes. Yeah.
Yeah. So
my question for the firm was, though, I said, okay, so if I gave you $525,000 and I said, you grow it however it needs to be grown, and I won't touch it for 7 or 8 years, you can't make that pay me $60,000 a year for the rest of my life? You can't grow that enough with an 8-year head start?
No, probably.
That would be a pretty good growth rate, actually, because you're talking about $1 million bucks.
See, but that's the difference, because here we're comparing apples and peaches, because you don't want the money to generate 60,000, you want the money to generate 40 or 50, because if you withdraw some of your principal along the way, along with your payments, you'll get your 60. That's what you're doing. Remember, you are not taking out just the interest. You're taking out part of your principal every year. I see
what he's saying, though. He's saying, wouldn't you be able to grow it enough so that you could take out 60? And
probably
not in that period of time. No, that'd be pretty fast.
But it's not a fair comparison either, because right now you can't get your $520,000 back. It belongs to them. If both you and your wife die the first year, your return will have been $60,000. That's it. If they grew it into $800,000, then your first payment, you could probably have taken $40,000 out without taking down the principal. And if you died, your estate would get $800,000.
Yeah, let's go back to the beginning, though, because what Andrew said, and not to talk you like you're gone, but this was all about, as it is for most people, retirement income. Now, you mentioned you have a pension. You mentioned you're going to get Social Security, which we fully expect that you will. But you wanted something to fill in the gap. But if you have all these other assets, you don't necessarily need a guarantee, which is what they were selling you. Look, we're going to make sure we fill this amount in so that your income's guaranteed. That's the trade-off that you paid the big commission. In other words, and I don't even know, Don, I always forget the fees on fixed income annuities, what he's paying out every year for the money to be there.
There aren't any.
Okay.
There aren't any ongoing fees.
Yes, there aren't any fees.
Yeah.
Because they're making whatever they're making, and then paying him less than they're making. So they're making, let's say, 7% on the money and paying him 5%. Or whatever the return is right now as a fixed income annuity. But I think what Tom's saying, and I think my point too, is very similar. If you had just invested that $1 million for the next 6 years, and you invested it pretty typically, 60-40, not too aggressively, that million would probably be about $1.7 million to $1.8 million.
Something like that, yeah.
Somewhere in that ballpark. And $1.8 million can generate, what can $1.8 million at 5%? So that's $90,000 a year. $80,000 to $90,000 a year. The 4% rule would say $80,000 a year you could get out of that money.
72, but who's counting? But yeah,
I'm rounding.
Close enough. Yeah. So, but I get why you did this. I understand, and I understand the emotions around this, because we all sort of want a guarantee. My take would be, as a good financial planner would say, you have two pieces of pretty guaranteed income, and you have these other assets. Those can supply it with a modicum of risk. That's how I would look at it.
Yeah, I'm just mad at the insurance company. I truly am. I think that the way they behave is deplorable. They were embarrassed to tell you the commission. They knew exactly what it was. They were counting on that commission before you signed the papers. They were figuring out what they could do with that big fat check in the weeks before.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Our phone number is 855-935-TALK, 855-935-8255. During the break, I actually went and ran the numbers because I was just going off the top of my head on the numbers before with Andrew. But let's just say for a second, Andrew took his $1 million today.
But he didn't give him $1 million, only gave him $500,000.
No. He had $1 million, though, total, all his money.
Yeah.
I'm just talking about all his money.
Okay.
If he took all his portfolio and properly invested it, okay?
How aggressively?
Balanced fund aggressively. I figured
70-30.
Yeah, a 60-40, which would be which has traditionally been about 7% per year on average.
Going way back. Yeah, okay.
Going way back.
Yeah.
So let's say he did that. His $1 million would have in 6 years become about $1.5 million. All right?
In 6 years.
6 years. $1 million, $1.5 million, 6 years. At 7%.
Okay.
Okay? That's right. Think about it. Rule of sevens.
Makes sense. Yeah.
Okay. So then 6 years from now, he takes that $1.5 million and he invests it even more conservatively, like 40-60 or 30-70. Only returns about 5% a year. And because remember, he said he was at a loss for income. He needed an extra $60,000 a year. That's what they did the annuity for, to get him $60,000.
That's right.
So in 6 years, he could take out $6,000 a year, $5,000 a month, every single month. And by
five a month.
Five a month.
Yep.
At the end of 30 months or 30 years, 30 years at 5% a year, which is a very conservative return, he would have $3 million.
Still.
And have collected $60,000.
And it would still be his money. And it would add all the end stuff. Yeah. All right. Fair enough. But it's the guaranteed nature. It's the trade-off. It's I don't have to think about it again.
It's not a terrible thing.
No.
What I despise is the means by which they are sold.
Yeah, and they're lying to him when they say they don't know how much they're getting paid. Of course they know.
Absolutely knew exactly what they're getting paid. Because
they were embarrassed.
I know. I was in this industry. They tell you your commissions in advance.
Of course.
And I would have a very hard time keeping a straight face with a client across the table who's getting ready to sign a piece of paper. I would be very, very scared that I was going to lose this sale by blurting out $45,000.
At least bring him out on the boat you're getting or something afterwards.
Yeah.
I don't know.
Or, buy him a new grill.
Plane trip somewhere or something, first class. I don't know.
Get him a nice tomahawk steak.
Okay, now you're really, which was awesome, by the way. Thank you.
Anyway,
that's good.
Give us a call. 855-935-TALK is our phone number, 855-935-8255.
Okay, but we didn't quite finish that.
Oh.
What should he do when it's out of surrender?
Oh, I don't know. I truly do not know. I don't know the answer. I because the problem is he's not going to have that much when it's out of surrender. I don't know what the rate is on the annuity, but
that's the thing. Number two, though, is because he bought it. It suggests to me that he may be risk averse in some way, and maybe that will be a good thing to have that guaranteed income.
Yeah. But, you're right. You're right. And for some, but, I find that type of person a lot more rare than most would have you believe. Once you explain
that, I don't know. It's hard to know.
Reality, yeah. I think, and by the way, I just ran the number. If he took out of his $1.5 million, $7,000 a month for the next 30 years.
Yeah, $84K a year, yeah.
He would still have about he would have just under $1 million in 30 years, taken down a little bit more than it was making.
It took out quite a bit. Yeah. But it wasn't guaranteed.
If we did this just right, we could run out of money the minute you die.
Let's just run that number but then you have that unfortunate thing of knowing 2 days, 3, 2 years, 3 days, whatever you got. You'll
live a little longer and I can't pay the bills. That's why you have credit cards.
It's not going to work.
All right. 855-935-TALK is our phone number. We also get questions sent in to us at talkingrealmoney.com. They can be typed. They can be spoken. Tom gets the typed. I get the spoken. We've got a few of the typed ones sitting right there in his grubby little hands, and hopefully we get some spoken ones from you during this hour when we're live doing our show on Northwest News Radio in Seattle that becomes a podcast the next week. 855-935-TALK. Give us a call right now. Thanks.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
It is the radio show, soon to become a podcast, that helps you deal with money better and panic less and maybe make more and stop getting ripped off by people because there's so many people doing the wrong things. 855-935-TALK is our phone number, 855-935-8255. And we get questions all the time from talkingrealmoney.com on the contact form. And Tom keeps a big old stack of them in his grubby little hands there. Look at them. There they are.
Very grubby, very large. I got a lot of questions. This one comes from Warrington, Pennsylvania, from Joseph. He says, you very often, every podcast, talk to the need to include bonds in a portfolio. Curious. BND has had an average 1.5% return over the past 10 years. The CPI over the last 10-year period was an average rate of 2.4%. So investing in bonds only costs approximately 1%. I think not. The often cited mantra of past performance is not indicative of future return wears old when we have to evaluate its past performance. Even as you state, we cannot foretell the future. Bonds are not an investment, but rather an expense, especially for an 80-year-old, an expense we need not. As the disclaimer at the end of the podcast states, entertainment only, not financial advice. Then he says, we'll have to look at foreign investments next. Wonder how much we would lose following that advice. By the way, he adds, Bernie Madoff was a fiduciary advisor. He wound up in jail. Joseph, this is good. There's a lot to chew on here. So I appreciate gosh.
Okay, first let's start with bonds.
Yeah.
The long-term history of bonds. See, when we talk long-term, that's not 15 years. Now, if you're 80, 15 years is definitely long-term.
It's a good point.
It's definitely long-term. However, historically, bonds have had reasonable return and reasonably low volatility, with the exception of really out of the last 100, about 1 year.
You can go back to 1970, the return of an aggregate bond, the aggregate bond funds have been about 5% a year, and inflation's been about 3%. So your net has been small. Yeah. I don't think that he's looking at it right.
Well, I agree. I don't think he's looking at it right, but that's what people look at. They're so they are so indoctrinated into the past performance concept, and past performance to us means 100 years. That's more indicative of what is likely to happen than just the last 15 years, because those past 15 years are so dramatically skewed by 113% loss.
Yeah, but I wouldn't even be looking at that. I'd be looking at, you want to take a look at today, right? As global stock portfolios down 10, if you have 40% of it in bonds, you've only lost half of that, 5%. Most people can't stomach even a 10% loss, much less 20, 30, 40, 50, which you can get from an all equity portfolio.
And that's our argument. What is your alternative? We do not want you to have 100% of your money in the stock market because you think a 1% return is pathetic. Try a negative 50. A negative 50 hurts a lot. That is why we suggest bonds as a portion of a portfolio to ameliorate that 50% decline, to buffer that, to soften, to cushion the blow of that. They're not a place to make money. We never say buy bonds because you're going to make a lot of money, because you're not.
No,
you're never going to make.
So
a lot
thank
of money.
you. And so yes, I love that. A bedrock, solid. Did they have a bad year a couple of years ago? Yeah. Have they had a tough 15 years? Yeah, kinda. But again, this year to me,
it really
shows
was
you everything
basically
you need to know.
because remember, 5 years ago, bonds were making zero. I mean, they were paying zero interest.
Yep.
So when you have a few years of zero interest and not a lot of fluctuation in the value, and then you have a 13% down year on something that is earning just a smidge over zero,
but if
really
it's all
kills
about just
years of return,
making more money, Joseph, then you're correct. Just put it all in stocks. They have made more. You just have to be prepared with
Just wait
We
until
can go
that
into the
down
years
year.
if you like 2000, 2008, spring of 2020, the spring of 2025. Anyway, I just, all those years were
and then back to his little international argument.
Well, no, I'm getting to the next two. Yeah, international.
Oh, okay. Yeah.
He says, we'll look at international investments next. Wonder how much we would lose following that advice. Well, again, time perspective here. Long term, international has actually added just a little bit more return, but it's reduced volatility because you hold more securities. Long term.
If you were
Since
an investor
2008,
between
not the
2000,
case.
if you were an investor between 2000 and 2010, and your portfolio was about half U.S. and half international, your average annual return would have been in the 7% range.
Yep.
If you own just the S&P 500, your average annual return would have been a loss of about 1% a year.
Say that again. You lost money for an entire decade.
In the
It's
S&P
a
500.
long time to get your money back. Okay.
Now, let's go to the other thing. Do we know the future? No. Do you?
No, he says that. Okay. But so do I think you should be globally invested? Yes. Do I think you should most of us have some fixed income? Yeah. But then, by the way, Bernie Madoff was a fiduciary advisor. He wound up in jail. What's the difference between Bernie Madoff and, for example, Apello Wealth?
Well, Bernie lied.
Well, yeah,
Bernie,
okay, but any advisor can lie.
Yeah, no, but Bernie lied, and Bernie was his own custodian.
Thank you. Always have a third-party custodian. We do not take your money. Your money is held by Charles Schwab. So I can't take it. I would never hire anybody where they're the custodian and the advisor. It's just a risk I don't think you need to bear. So, yeah, Bernie, and I don't know that was he an R? I guess he did have a part of the business that was a registered
he was an
investment advisor.
RIA.
He does. That's right. Yeah, he did. And then he slowly was forced to register it as a hedge fund, I guess, at some point, even though he was making up all the numbers. But you're right. He wound up in jail. He was a fiduciary advisor, but he took your money. He was up in the whatever floor in the lipstick building making up those statements. Like, look, you're looking great.
Right. Couple floors down, he was making them up. A couple floors up, he was making the pitch.
So if you have a third-party custodian, you can any day log into that third-party custodian and see your money. They will also send you reports as to how your money's performing. So you have a separate party that's doing all that. Helps alleviate the issue.
What I really wonder with Bernie is because there was Bernie Madoff Securities, which was his holding company. How did they have SIPC insurance? And how in the world did they get it? And did SIPC step in? It's just all very curious to me.
Well,
855.
I do know. Yeah, go ahead.
Oh, I was just going to give the number.
That's enough on Bernie.
935 Talk is the phone number. And Devin, you are next on Talking Real Money.
Awesome. Hi. How's it going?
Hey.
So I play in a different world than you guys. You guys have a lot more in your bank accounts than I do. But I just put a call on SQQQ, and I could see that the market was headed in the wrong direction. And so in the last couple of days, my 10,000 has turned into 30,000. Do I pull? I mean, what do I do when I pull this money out? Because this is literally the first thing I've even invested in. So
prepare to pay taxes.
40 grand liquidity. Yes. But pretty low. I mean, comparatively, like I'm not touching huge profits here. So it's still done by scale, right?
I'm not sure I follow.
Wait, you said 10 to 30, right? I mean.
Right. So I've got 20 grand profit on this. But I believe the
short-term capital gain if you sell it.
Right. And that's based on the amount. It's not one universal short-term capital gain cost, correct?
I don't know what you're saying.
Short-term capital gains are at your income rate. Whatever your marginal income rate is, that means your top rate on all of your income. That's the rate on which you will pay this short-term capital gain. Short-term capital gain is just another word for income. So you're going to pay the highest possible.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Oh, well, it's been quite the week this week. I think I'm exhausted.
Me too.
I am actually exhausted because this was a week where There were a lot of things going on. We were doing a lot of research. We were changing topics, looking at things to talk about. And it ended up being the same old thing again. The market just gets stupid at times.
Yeah, and you have to be prepared for that. Yeah, you literally have to have your portfolio with that in mind, because we don't know what thing will trigger that, whether it be COVID, whether it be interest rates. Now it's tariffs, but you got to be ready.
And what this proves is how emotional the market is, because what we call the market isn't anything but a whole bunch of people betting
Somebody said
on the direction of something, somewhere, sometime, or on the future. And, there's a lot of gambling going on day to day that we don't want you to be participating in. Yeah, an SQQQ, which is the pro shares ultra short. It's gambling. It's betting against the market, and it can be really lucrative right up until it isn't.
And you could work the other way. So
don't do it, by the way.
No, we don't recommend. He already said we don't. Well, actually, I said we had a lot more money in the bank than he did, which I have no idea how he knows that. But
apparently, he's trying to get more too fast.
Yeah, that's as you said, pure gambling. So no, I mean, the people that survive these things have a plan. They have the right risk tolerance. They're properly diversified. And they know it's happening, but they're not emotionally tied to it, because it doesn't really matter in the long term. The long term is the long term. These things will come and go.
And we believe that's the only way to survive this world long term, is by having the plan, by acting on the plan, by sticking with the plan, and by doing that oh so difficult thing to do as human beings, controlling our emotions.
It is hard. Yeah, we're emotional beings.
It's really hard.
Yeah.
You cannot let how you feel dictate how you react with your money. Let it dictate how you react in a lot of other ways. Sure. Family, friends, be sports. As emotional as you want. Sports, all of those things. Just get rid of the emotion in the financial aspect, because that's the thing that can really hurt your future. And we want you to have a great future financially, not a conflicted, confusing, awful one.
Troubled. So
troubled is a very good word.
Yeah, difficult. So if you want a little help, by the way, we do offer, we review portfolios. We talk to you about your plan. We do all that. You get a free hour of our time to do all that stuff. You can,
don't take it off if you don't need it.
So, to get that, pretty easy. You go to talkingrealmoney.com, click on Meet an Advisor. Yeah. And I want to thank the folks who signed up in Phoenix, by the way. I am sold out of meetings when I visit there. So I'm looking forward to that. Booked up. So I'm really excited about that. But if you do want to have a chat about that, then let us know.
You're going to be down there a little bit longer? Couldn't you spend a little bit more time, a little bit more of your vacation?
I like that. Yeah, something like that. Yeah. If it stays at 90 degrees, then yes, you can plan on that, I think.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.